GDS Holdings, China's premier carrier-neutral data center operator, led by founder William Huang, entered second quarter earnings, riding a massive artificial intelligence build-out for hyperscalers like Alibaba and Tencent. Yet the results delivered immediate tension. Net revenue and earnings per share arrived slightly below market consensus. Despite the near-term headline miss, underlying operational velocity presents a very different picture. The company recorded record quarterly new bookings, raised its full-year top-line guidance, and saw its Singapore-headquartered international arm, DayOne, prepare for a landmark U.S. initial public offering. Net revenue reached 3.088 billion renminbi, or roughly $455 million, up 6.5% year-over-year. Adjusted EBITDA rose to 1.406 billion renminbi, approximately $207 million. Net income officially swung into positive territory at 837.6 million renminbi, or $123.5 million. However, that print was driven primarily by a one-time non-cash gain from the dilution of its stake in DayOne, while underlying core operations posted a small continuing loss. Operational metrics showed powerful demand, featuring record quarterly bookings of 260 megawatts and bringing total committed area to nearly 785,000 square meters. Management confidently raised full-year 2026 revenue guidance to between 12.7 billion and 13 billion renminbi. On the international front, DayOne confidentially filed for a US IPO targeting a valuation up to $20 billion, with plans to raise $5 billion following a $4.5 billion series. DayOne controls 480 megawatts in service or under construction, plus another 590 megawatts reserved. To fund this massive geographic capital expansion, GDS relied heavily on debt markets. Analyst Q&A highlighted execution details across 6 key institutional exchanges. Yang Liu from Morgan Stanley opened by questioning potential downside risks to next year's customer move-ins given GPU supply constraints and whether take-or-pay terms offer true downside protection. Management answered that domestic GPU supply is catching up while traditional CPU demand remains robust with zero supply bottlenecks. Chief Financial Officer Dan Newman emphasized that contracts contain unchangeable 4-quarter delivery windows. Sarah Wang from UBS inquired about the demand profile and contract terms of emerging artificial intelligence leaders compared to established internet hyperscalers. Management explained they are building dedicated teams to serve these emerging players while remaining highly selective, maintaining primary focus on large hyperscalers but diversifying the client base for long-term growth. Frank Lauthan while pressing management on declining monthly recurring revenue per square meter, will drop 3% year-over-year due to geographic mix changes into lower-cost regions. And Daley Lee from Bank of America Securities approvals. Management attributed current move-ins to capacity booked in 2025, forecasting a major move-in acceleration in the second half of 2027, while explaining that power allocations require step-by-step municipal, provincial, and national approvals, where GDS secures land early due to strong local relationships. Edison Lee from Jefferies split between training and inference workloads. Management clarified that bookings and reservations are bundled into the same binding sales agreement, with customers exercising reservations at nearly a 100% rate over the last 18 months, while doubling full-year booking targets to 1 gigawatt based on surging demand across both training and inference. Management projected a 50-50 split between CPU and GPU workloads near term, with GPU weighting rising next year as chip supply improves, adding that 2027 move-ins will more than double to near 700 megawatts and position data center operators from capital-heavy real estate plays into scarce compute infrastructure providers. GDS Holdings has positioned itself directly in the flow of this structural transformation. Yet with leverage high and financial results swinging on non-cash items,